While we wait for Friday's full disclosure of how those 91 banks shaped up, several nations in Europe are heading to the markets today in the latest round of government bond auctions. So here to help us look at the prospects for the sales is Gary Jenkins, fixed income strategist at Evolution Securities. Thank you so much for speaking to us. So what are your expectations ahead of today's bond sales? What are the prospects?
Oh, I think they're all going to be fine. They're all either very short-dated or very small amounts. And we've seen a sea change, really, in the way that sovereign bonds in Europe have performed recently. We've seen some very successful auctions by the Spanish, some rumours of Chinese buying, and some indicators that really the market focus is moving away from the concerns of the European sovereigns and looking more at maybe the economic data and the upcoming stress tests.
So from what you're saying, whether or not investors buy these bonds, it's not necessarily going to mean that the threat of default has receded?
Well, investors have to buy the bonds, otherwise we're facing a really serious problem, obviously, immediately, but they will buy them. And if you look at what's happened recently, the ECB has cut down on its buying of government bonds. They only bought 300 million last week after averaging 6.5 billion for the previous 9 weeks. That suggests there's less need for them to step into the market. And most interestingly, what happened on Spanish 10-year bonds last week, for the last 2 days of the week, the IBEX went down over 1% on each day, yet Spanish bonds gained in price, which suggests that they're acting like a traditional risk-free government bond again rather than the credit. So that's very important, and that means that there's a lot more interest in buying this kind of debt at the moment than there was a couple of months ago. So
from what you're saying, since Spain's auction last week, the emphasis has shifted somewhat. What's the market focusing on right now?
Well, I think the market's looking very much at the economic data and company earnings, and that's what's really moving the market right now. If you look at yesterday, you had negative news out of Hungary, you had a downgrade for Ireland, yet the market didn't really move on any of that. It was only on US housing that we actually saw a market reaction. Now, obviously, the upcoming stress test could change things, but for the moment, and this market is very short-term and things can change very quickly, but at the moment, the emphasis has definitely gone away from sovereign debt.
It's interesting you say concerns about sovereign debt have abated somewhat, and we are expecting the results of those stress tests at the end of this week, and already Bloomberg has learned that German bank Hypo Real Estate may well have failed those tests. That's not going to inspire much confidence in European banks, is it?
I actually think that's probably good news. If all of the banks passed, then quite frankly, instead of all being winners, they're all losers, because the test would have no credibility. You have to have a few that don't pass the test. Otherwise, the market's just going to totally ignore it.
It's a double-edged sword, isn't it?
Yeah.
So you have to, the tests really have to reveal some weakness in Europe's banks to show that they have, in fact, been stringent enough, credible enough. But what is the reaction likely to be amongst bond and equity investors?
Well, I think what's going to happen, and a lot will depend on the actual results of the tests, and then just as important, the assumptions that were behind the tests. And once we get those absolutely confirmed on Friday, hopefully, and we see the results, then I think the market reactions are going to be pretty neutral, really. I don't think that the assumptions, from what we've heard, are really harsh enough, but at the same time, I think that just having the odd failure here and there, which will be solved because the governments of the day will put capital in, I think it will be fine.
Gary Jenkins, thanks very much for joining us.